I'm a CPA and I've helped hundreds of business owners save thousands of dollars on their taxes. So, in today's video, I'm going to show you exactly how you can save thousands of dollars on your taxes by using 7 strategies that, quite frankly, nobody really talks about. The truth is, there is so much fake tax advice online, and simply, a lot of it isn't true. Now, the problem with bad tax advice is that it can literally land you in prison, just ask Wesley Snipes, or it can leave you with fines, penalties, and interest that you have to pay back to the IRS. Now, before we get into those 7 strategies about how to pay less in taxes, if you are looking for somebody to actually take this off of your shoulders and do it for you, click the link in the description of this video, apply to work with us, and we'll do all the heavy lifting for you. As a CPA, I can tell you with 100% confidence, all of these 7 strategies, they're 100% legal. Before we actually get into these strategies, we actually have to know, how exactly do taxes work when you are a business? So here's the deal. You're actually taxed as a business owner on what's left over, not your income. So you are taxed on your profit, not the money that comes into your business. So let's use this as an example. As a business owner, let's say that you earned $500,000 from customers paying you for mowing their lawn, right? You have a lawn care business and you earn $500,000 from going to people's homes. In the process of that, you spent $400,000 on things like payroll, gas, maintenance, lawnmowers, and everything like that. And then at the end of the year, you end up with $100,000 in profit. Now, the way that the tax system works is you want to look at your tax rate. And again, this is just an example, but it's more to understand how everybody gets to this point. If your tax rate is 20% in this example, that means you would have to pay $20,000 in taxes, whether it's to the IRS, the state, self-employment. It's irrelevant. It's more that you understand how it works because this is so fundamental. So now that we understand how we're taxed, you really have 2 options if you want to pay less in taxes. Number 1, you can just make less money, which for all intents and purposes, nobody wants to do. Nobody wants to make $100,000 and say, you know what? I think I'm just going to collect more or collect less. Nobody ever says that. Option 2, which is completely legal and the one that I like, is that you really want to find more legitimate business expenses to lower your income, right? Think about that example. If you were making, or if your profit was $100,000, but then you could find or come up with $20,000 more of legitimate business expenses, well, now you're taxed off of $80,000. Way better. And really, that second option, that is where tax strategy lives, right? It's about turning the money that you're already spending into deductions and setting up your business so that you can take advantage. So here are the 7 legal ways to reduce what's left over at the end of the year. And quite frankly, these are the same strategies that I use with clients every day. And the beauty of it is, it does not matter what industry you're in. Whether you are a plumber or you are a YouTuber or anything like that, all of these work. All of these is something as simple as choosing the right entity structure, separating your business and personal funds, pay yourself correctly or the right way. You want, and this is one of my favorite, you want to turn personal expenses into business deductions, but you want to do it legally. Hiring your kids using the Augusta rule, which is completely bashed online or explained wrong, but we're going to get into that. And number 7, plan before year end. I promise you, those are actually very easy to follow. So the number one thing we want to do with all our business owners is that we want to make sure that they are in the correct entity structure. Here's my philosophy. Before you start worrying about tax structures and all this crazy stuff, you have to have an actual business. And what I mean by that is someone is actually paying you for a service that you provide. Until money has actually changed hands, you don't need an LLC, you don't need all this fancy bullshit. You just need to be a sole proprietor, right? Now, the reason why I like to say $1,000 is that $1,000 is real money. It's a proof of concept. And again, this $1,000 can be from 1,000 people paying you $1 or 2 people paying you $500, right? You want to make sure you have a proof of concept. Now, the reason why I say you just want to be a sole proprietor, don't worry about LLCs, is that a lot of times LLCs cost money and they add complexity before you really even need them. Just operate as a sole proprietor. For example, if you want to open up an LLC in California, it's going to cost you $800 every single year, whether you make money or not. That's a ton of overhead and money you probably don't have. Just start a sole proprietorship and don't worry about it. Now, after you've established that you're making $1,000, whether that's from one people or 1,000 people, once you've made $1,000, now you have a proof of concept. And most importantly, now that people are paying you, it is time for protection, right? You want to start with filing an LLC in the state where you live and work. A lot of times online, you'll hear fake gurus, so for to say, is that they talk about having entities in Wyoming and property or management companies and all this stuff to remain hidden. Right now, just focus on opening up the LLC in the state that you live and where you work. And again, most importantly, we want to look at what an LLC stands for: limited liability company or corporation. It separates your business assets from your personal assets, right? For example, if somebody sues your business, they can't take your car, your house, your bank account, right? That is the idea of what an LLC does. And again, the purpose is legal protection, not tax savings, right? We want to keep this simple. Once you've made $1,000 in your business, and that's after expenses, then we want to look at filing an LLC in the state where you live and work, and it gives you legal protection. That's all we're focusing on right now. Now, once your business is actually making a profit, that tax burden, it starts to feel really heavy. And this is why. When you are a business owner, you have three taxes that you have to worry about. Number one, your federal taxes, it's based on your profit. Number two, your state tax, which is also based on your profit. And your self-employment tax, which is 15.3% for Social Security and Medicare. Think of it like that. That is also taxed on your profit. Now, I hate to be the bearer of bad news, but you cannot avoid federal and state taxes on your business. That just ain't happening. You're going to pay it at all levels. Now, if you live in a state like Florida that doesn't tax income, that's great, but you're not escaping it unless you move. There is no law or snap of the fingers that says California taxes are gone. There's none of that. But you can reduce the amount of self-employment tax that you can talk about. That's what you hear about when you talk about S corps. Is that's the tax that you're really eliminating or reducing it. Now again, once you are an LLC that is making around $80,000 in profit, you want to start doing this thing what is called an S corporation. Now, let's go back to the basics here. When you are a sole proprietor or taxed as an LLC, you pay that full 15.3% on all of the profit. However, if you have an S corp or elect to be taxed as an S corp, you can actually split that income. So let's use our example of above, right? Of $100,000, right? You can actually have some of that paid out to you as a salary, which we'll get into. You do have to pay the payroll tax or that 15.3%. Not getting out of that. But let's say you take some of that salary distribution, that's not subject to the 15.3% at all. So in our example, again, you can split that. And again, there is a little bit more nuance to it than that. But if you make $100,000, right, that $50,000, that's taxed normally, right? You're going to pay that full 15.3%. But on the part that you deem a distribution, that avoids that 15% self-employment tax. And again, this gets you to your approximate savings of $7,500 to $8,000. Again, this is a bare bones example, but it's more the idea. You need to understand what is going on because there are so many gurus out there or online charlatans that will tell you, oh, just become an S corp. Well, let's actually break this down and back up. How do taxes actually work? Now, again, it really comes down to timing because if you're under $80,000, right, you have to take a salary, which means you have to have a W-2, you have payroll software, you have compliance, you have an extra tax return. So really, if you are making under $80,000 a year, sure, you can save that, maybe 5 to 6,000, but it gets eaten up between all of these costs, right? So it really is timing that unless you're making 80,000, you don't want to consider this. Now, let's summarize this whole section on when to choose the right entity structure and when not to, because we want to make it really easy, right? When you are under $1,000, just a sole proprietor, right? Because you just want to test your idea. Don't worry about LLCs. Don't worry about all this other bullshit. You want to make sure you actually have a proof of concept. Once you are making over $100,000, you want to have an LLC simply for legal protection, right? Because that now you have something to protect. And again, between that $1,000 and $80,000, just keep the LLC. Once you are making $80,000 in profit, then you can elect to be taxed as an S corp and see where it starts to make sense. Now, next up, you want to make sure that you are separating your business and personal finances or your funds. Right now, this sounds boring, but really, this is the difference between clean books and chaos. And let's be honest here. Nobody wants chaos, right? When you only have one bank account, a personal, and all of your business income goes in there, it is super hard to see what you've made in business, because again, you're taxed off of your profit, and if you have to take out all of these personal expenses, it makes it almost impossible. So again, you want to open up a dedicated business account and a credit card. That means that all of your income and all of your expenses go through your business accounts, right? So if somebody pays you to mow their lawn, you deposit that check or um, that Stripe account, that gets deposited in your business account, and then if you have to pay for a new lawnmower, you are paying that with your business credit card or your business checking account. Now, the second thing that you want to do is you want to make sure that you are keeping receipts and documentation, right? Use a spreadsheet. Use a Google Drive where you can take pictures. There's all kinds of apps that also do this for you. If you just take a picture with your cell phone, just like this, it makes the documentation super easy. Now, aside from keeping all these things separate, it actually makes it really easy to tell how much money you've made. Think about it this way. Let's say you have a business account, a business bank account, right? And it's like, man, I don't know how much profit I've made. I don't know what I'm going to pay in taxes. However, if you look at your beginning business bank account balance in January, let's say it's zero, and then you look at your business account at the end of the year and it's at 50,000, well, you know you've made at least $50,000. It makes tax planning, tax prep, it makes it so much easier because you don't have to spend hours, days trying to clean it up later. Now, another one too is mixing accounts can be potentially not necessarily a red flag, but it just makes it harder. For example, if you have a business, but you are paying your rent out of there, you're paying your kids out of there, and you're going out to dinner and buying all this stuff, the IRS is going to say, well, this is kind of hard to tell what's a deduction and what's not. And if you're ever under an audit, it makes it more difficult. Now, there is the Cohen rule where you don't have to have receipts for everything, but I'm telling you, it just makes it a lot harder. And again, clean books equals clear deductions. You know exactly what's deductible and what's not. Now, number three, let's actually talk about how you pay yourself. And I don't really mean how you label it in QuickBooks and bookkeeping, it's how you actually do it, right? You want to pay yourself correctly. Now, most business owners, they simply don't pay themselves. They actually just spend their business money. Now, what do I mean by that? They use their business account for things like groceries, gas, the mortgage, all from your business account. Now, in QuickBooks, it looks fine because, hey, it's going in there. It looks good, right? But in real life, it's actually a mess because you don't know what you're spending. You're just swiping your card. And that's actually terrible for how to manage stuff. Now, the way that I like to fix it with clients is you want to get on a monthly schedule, right? Think of it like you're an employee, right? Now, before you do that, you want to pick a number, right? Let's say that you've determined that you need $10,000 a month to live. Well, you just simply transfer it from your business account to your personal account. You want to treat it like a paycheck, right? Think of it, right? Like when you have a job, you get paid the 1st and the 15th. You get paid every 2 weeks, every other Friday. There's a schedule. It's not random. Same thing here. You want to pay yourself a fixed amount each and every month and then just simply transfer it from the business to your personal account. Then once the money's in your personal account, now you can go buy gas, mortgage, all that stuff. Right. And now the result of that, right? It's clear books. You know exactly how much you're paying yourself every month, better visibility, and most importantly, you have more control. And this is going to be the same mechanics, whether you're an LLC or a sole proprietor, right? It's a draw, or you're an S Corp, it's payroll. It really doesn't matter. The point is consistency, right? It gives you clean books, visibility, and all of that stuff. Now, the next thing we want to talk about is turning your personal expenses into business deduction. And really, this is where things start to click, right? You're already spending money on things that qualify as a business expense. You just have to make sure they have a business purpose. Now, let's think of some examples, right? A home office, right? All of us have a home office or somewhere that we work. If you are a business owner, right, you get to deduct some of that. Think of the home office. All you have to have is you have to have a separate area that's business only. So let's say your mortgage is or your rent is $1,000 and your home office takes up 10%, or your home office is 10% of the total space of the house. Well, now your rent or your mortgage, 10% of that just became a deduction, right? You want to take things that you're already spending on and make them business deductions. Same thing with a vehicle, right? If you are driving for work, you're already going to pay for gas. Now you get to actually deduct it. And the same thing with your phone, right? A portion of it is business deductible, right? This is my phone, right? Sometimes I take personal calls, sometimes I take business calls, right? It's a mix. I'm going to pay that bill no matter what. But if I can add some of that bill to my deductions, well, now my taxable income goes down. And again, rule of thumb is that it has to be ordinary and necessary for your business, right? We all need cars, we need a home office, we need a phone, we need things like that. And again, documentation and usage is important, right? You want to document how much of your home office is actually, or how much of your home is used for your business versus how much is personal. Same thing with miles. Track them in an app. You can use your phone. You can use MileIQ, QuickBooks Online. And same thing with your phone. The way that I tell people is it's probably a better idea to go about it 50-50. Right? We want to say if we're working 8 hours a day and we're out of work 8 hours a day, that means it's 50-50. And again, these are things that we're already paying for. We're just making them tax deductible. Go back to that example of $100,000. Well, if you weren't deducting your home office, your phone, and your miles, well, now that 100,000, that just became more business expenses, and you can pay less in taxes. Now, the fifth thing that you want to be doing is you want to be hiring your family, and most importantly, your kids. Right? You want to hire your kids to work in your business. The reason why that is that you can actually shift income from your business to your kids. For example, in that $100,000 example, right? If you can find a way to pay your kids $2,000 a year, now your business gets a deduction. Your taxable income goes from 90 or 100,000 to 98,000, and then that $2,000 goes to your kids. Now, again, you have to pay your kids for legitimate work inside of the business, right? You can't pay them to model when they're a toddler, right? You want to wait until they're probably like between 7 and 10, where they can do things for you, like take out the garbage bin in your office. They can set up this camera that I'm using. They can set up this mic, right? They can actually do things. Now, their wages are a business expense. It's legitimate because you have to hire people. Now, most importantly, when it is legitimate, you have to pay them a market wage. If you would pay somebody $10 an hour to set up your office, well, then you're going to pay your kids $10 an hour. But again, it's a business expense, and it's things that you are already doing, right? You're already probably paying them to do chores and stuff like that. You might as well just make it a business expense. And when your kids are paid under $15,000, you don't pay federal income taxes. Now, the standard deduction, it changes each year, but just know in 2025, it's roughly $15,000. So when we talk about shifting income, right, that money goes from your business to your kids. And if your kids are making under $15,000, well, they don't have a federal tax obligation. And again, the reason why I like this is it keeps money in your family, not the IRS. And it teaches your kids a lot, like how to sign a contract, how to show up on time, how to budget their money. All of this stuff that they get to learn, and it ends up giving you a tax deduction. And again, it's money that you would have already spent. You're already going to pay your kids for chores. Let's just actually make it legitimate to where they can do work inside of your business. Now, the sixth thing that you want to do is you want to use the Augusta rule, right? But what exactly is this? The IRS has allowed, and this is anybody, if you own your home, you can rent your home up to 14 times per year, no matter how much somebody pays you. So let's say you go on Airbnb and you rent your home to a stranger for $1,000 a day for 14 days. Well, if you do it under 15 or 14, no matter how much you make, whether it's 14,000 or 14 million, that money doesn't have to be paid, or that money is tax deductible and gets to be excluded your income. Now, let's look at how you would do this for your business. You can rent your home to your business, and it's a tax deduction, which is here. You get a tax deduction, and you personally get tax-free income. Now, most importantly, though, for this rule, which obviously gets left out, is your business has to pay you fair market rent. For example, I live in Des Moines, Iowa. I have a 3-bedroom, 2-bath house. If I went on Airbnb, VRBO, or any of those other sites, my house would typically rent for about $200 a day. That means if I want to rent my home to my business, I have to charge myself $200, right? You cannot just simply pay yourself $500,000 a day because that's what you think. It's what the market would bear, what somebody would actually pay you. Now, again, I'm using this as an example, right? If you have 14 days and you pay yourself $1,000, that's $14,000 of tax-free income. Because again, let's go back to what this is, right? On your business. Let's say you're at $100,000. You can simply write yourself a check for $1,000 14 times, and you're going to take $14,000 off that $100,000. That is tax-free income. But again, I cannot stress this enough. It has to be fair market rate, and you actually have to have documentation, and something had to take place. For example, if a stranger was going to rent your home, right? You're going to make them sign a lease. They're probably going to have to pay up front. There's all these rules they have to have. Same thing here. You're going to sign a lease with your business and you're going to pay yourself. And as long as you do that, you'll be able to pass an audit with flying colors. That's what most of these gurus don't tell you, is that you have to do it legitimately. Now, to bring this all home and put a bow on it, number 7 is you have to have a plan before the year end, because let's be honest, the real tax savings, it happens before December 31st, right? You have to go out and pay your kids, make that S Corp election, um, buy equipment. You have to do all of that before the end of the year. Now, the biggest tax savings, which is happening now in our firm, is really in October and November, right? You have to review the books in October and November. Now, this gets back to the example we talked about earlier, tied home, is having a separate bank account. One, there's liability, but two, it makes it easier. If I know that all of my business income went into one account and all of my business expenses came out of another account, I can with confidence say, well, if my bank account balance was zero in January, but in October it's $100,000, I know I at least made $100,000, if not more, right? So now it makes guiding you a little bit easier, right? So that's the number one thing. We want to review our books, right? The next thing we want to do is we want to prepay expenses or make end of the year purchases, right? Think about travel that you have up. For me, I'm going to be going to a conference in February. I might want to pay for that expense now, or maybe not in October, but I want to make that expense or make that payment before the end of the year because I am able to deduct that. Because again, it's all the expenses you have. So if you can pay for stuff up front that you're going to incur, that's going to help you save even more money. And number 3, you want to be contributing to a retirement plan, whether that is an IRA, 401k, a solo K, a SEP, all of these things. You want to be contributing, but most importantly, you want to know how that's going to impact your taxes. And if you know what your profit is, because we know we get taxed on our profit, and you can prepay some expense that you're going to incur, now it makes it makes it so crystal clear that all of our clients that we're meeting with right now, they know exactly where they are and they know exactly what they have to do. And it's one of those fundamental things. You have to know where you're at. And if you don't know where you're at, it makes tax planning damn near impossible. And again, I cannot emphasize enough. Once the year closes, and honestly, even in our office, if you make it to December 1st, it's over. Once the year closes, the opportunities are gone. So many times I hear from people in April be like, man, I didn't know I was going to pay all this tax. What could I have done? It's over, man. Once the ball drops at midnight on December 31st and Dick Clark or Ryan Seacrest now, it is over. And even in our office here, if you don't get to us by November 15th, it's over because we're not going to sit here and watch the ball drop with you. You got to do it beforehand. So now to put a bow on this, again, we want to bring it full circle. You're taxed on what's left over. Now, if you know what you have to spend in your business and then you can put all 7 of these together, that gives you extra tax deductions and extra tax planning. That is the true essence of tax planning. And again, taxes, they aren't about loopholes. They're about managing what's left over. So if you know where your profit is and what you can afford to spend and buy and do all this other stuff, then you know where you're at. That is the true definition of tax planning. And there are just some really smart intentional ways. Again, these are not loopholes. This is taking the tax code to their advantage and most importantly, being open and having the foundation set. Now, again, to wrap this up, taxes aren't about tricks and loopholes and all this stuff. It really is understanding the fundamentals and how the system works. You're taxed on what's left over. So if you want to pay less, you have to make sure what's left over is smaller legally and strategically. Now, I want to bring this home to a client. This was a client before working with us. They were set to pay $34,000. After working with us, it went down to $16,000. And again, a lot of them use those same strategies that we talked about, all 7 of these. So now, if you want us to do this for you and show you how to do it, click the link in the description of this video. We'll work with you one-on-one. And again, we'll do it for you. There's no guessing. There's no BS. There's no gimmicks. Again, my name is JT. Happy that you guys watched this video. Again, click the link in the description of this video, and I will talk to you guys on the next one.